We got to put the disclaimer. This is not financial advice from me.
It not tax advice either. None of this advice is specifically tailored for any individual investor or taxpayer, but this is educational information.
Exactly. Exactly. There's a lot of research that went into all of this. And so with that, let's get started for today. Thank you everyone for joining. My name is Brett. And today we will be discussing various topics related to cryptocurrencies, taxes, and the current market. A little background on myself. I'm an on-chain analytics specialist with Glassnode. Over the last few years, I've developed a lot of unique approaches to systematic research, a lot of those including quantitative investment strategies and risk factor analysis. Personally, I just love investing and finding just systematic ways to continue to beat the market. Joining me today is David. He is a US licensed CPA who specializes in the taxation of cryptocurrencies. David started his career in traditional finance, but has a passion for emerging technologies, which led him to the world of cryptocurrencies. He's now helping Accointing create the best tax solution for crypto taxpayers. And David, it's great to have you here with us.
Thank you, Brett. I'm definitely excited to be here, excited to join you, and excited to do the first webinar with Glassnode and Accointing together. I've known about Glassnode for a number of years. Very excited to be on the same webinar. And yeah, I mean, honestly, this is a very pivotal point in time in the USA right now, as we're seeing a lot of crypto regulation cracking down on us. We're seeing the actions, like Walls noticed by the SEC on Coinbase. We saw the Federal Reserve. Everybody's waiting to see what they're going to do next with interest rates and what's going to happen. But unfortunately, we got to take a step back and come back to the tax deadline, because every crypto investor, unless you've only bought and held, you probably have some crypto taxes to pay or report at least by the 18th. So obviously, that's our main topic today, and that's what we want to get into. Hoping to be able to deliver you guys as much value as possible, because as we all know, the markets have come down about 90% from a year ago. They're starting to recover, but point being, you guys, we have all lost a lot of money, a lot of funds in crypto. Let's not lose any more. Let's try to keep as much money as we can and not volunteer any more than what's rightfully due to Uncle Sam.
Yeah, and you're totally right on that. Things have turned around and we're thankful for that. But just before we get into everything, David, curious, what was it that brought you into cryptocurrencies originally?
It's a good question. And I'd say, honestly, like most people, I was very skeptical at first, because, if somebody tells you about crypto and you start to see these assets, you look at CoinMarketCap and they're seemingly moving up 20% per day, which is something very different for anybody used to working in traditional finance with equities and other assets. But then you start reading the Bitcoin white paper and you study the history of fiat currencies, and you realize that historically every fiat goes to zero. Why? Because of their relationships with the political interest that there is in monetary policy. And surprise, now we're seeing the same thing happen right now, as the main topic has been inflation, really around every single media outlet. So all of this, when you put it all together and you see the use case of Bitcoin, you realize just how amazing the Bitcoin network is, the security of it, the fact that there can only be 21 million Bitcoin ever created. You start to put it all together and you see the potential to separate the system into a much better store of value. Obviously, a lot of us know that. But then if you keep digging and you start to discover the smart contract side of it, thinking about the potential of decentralized finance without an intermediary, being able to get a loan with immediate access to your funds without having to wait for that loan, being able to settle instantly. I think the use case is there. And, even if you keep thinking about it, banking the unbanked, all the different countries that so many people don't have access to bank accounts, you look at all these different use cases and you realize that there's a lot of potential in crypto. And honestly, I think, that's what captivated me early on. And being a tax person, I was a tax manager at the time and working in traditional finance, decided to learn everything that I could. And here we are today, as I said, at a very pivotal moment in crypto.
Yeah, it definitely is a pivotal moment. You said a lot of interesting things there that I would love to unpeel, but let's move over to more of the accounting topics today and get started with our discussion. So first things first, it feels like the FTX collapse is just ancient history from now. But as we are now seeing, we do have to file taxes on the events that occurred related to FTX. I've seen some conflicting information on this. Could you tell us what we should do if we were using FTX back then?
Yeah, definitely. And the unfortunate thing is that this is a lot more people who would like it. I mean, FTX was seemingly everybody was using FTX at the time, or FTX US in this case. The bottom line is that nobody knows exactly what the right answer is at this point. And if you analyze the tax law, there isn't a specific way of properly deducting any funds lost on FTX. And this is for a number of different technical tax reasons. For example, you can try to deduct it using the worthless security deduction under Code Section 165V. Unfortunately, there's two pieces that don't work here. If you look at code section, number one, cryptocurrencies are not actually considered as stock or a security. And as we talk about other provisions in the Internal Revenue Code, such as the washout section, we can't call it a stock of security for one and not call it a stock of security for the other. So there's a little bit of conflicting information there that doesn't let us use that. Beyond that, number two is the fact that it's not a total loss yet. Just about a week ago, FTX actually sent an email. Anybody who had funds on there, you probably got a notice telling you that here's your claim number, here's your claim amount, and they basically told you, hey, hold on, we still don't have. They don't have a specific process or even a timeline right now. We basically said we're going to notify you when, and you can submit your claim. We're going to give you the instructions on how to submit the claim. Point being, there is a claim, so it's not worthless. It's still worth a little bit. So you can't write it off for taxes until you know what the amount of the loss is, which, based on the expectations of how long the bankruptcy proceeding is going to take, we're probably looking at 2023 or even 2024 tax rate at this moment. So
That's
again, sorry.
No, I was gonna say that's super interesting. Continue though. What were you gonna say?
Yeah, so I mean, my point is that nobody is expecting to recover anywhere near 100% of the funds in FTX. But the bottom line is that you don't know what you can recover. There is a possibility to recover some, so we just don't know yet. So between the combination of not having the right method in the tax law to deduct this and not knowing the actual amount of the losses, you can see where it is a tricky situation that unfortunately, it's difficult to make the case for a tax deduction today. Now,
That's wild. So
sorry,
it sounds like no worries. It sounds like the best answer is just to wait and see. Is that kind of the way you explain that?
Fortunately for tax, and my favorite answer, but least favorite at the same time, is it depends. Generally, yes. Now, if you have if you lost a very substantial amount, keep in mind these are capital losses. If you have a lot of other capital gains to offset, maybe you have a very specific situation in which getting the deduction this year might be worth it a lot more to you. I cannot give you, I cannot recommend how to do this, but work with a tax professional. You may be able to take a position. Granted, you'd be taking a position that's, a little bit controversial. So that's why you definitely want to work one-on-one with a tax professional here. I do know there's some people that may be willing to do this because if you look at it based on facts and circumstances, economically would make sense to make a deduction. The other thing is that if you keep looking, there have been some people online have suggested even ways of, if you sell your claim to the FTX, could you then write it off? I mean, if you figure out how to sell it properly, then yes, but obviously, it's not something that I recommend people to do it broadly because it's, next thing you know, people are going to start minting NFTs for their claims in FTX, and we're going to get into an even more messy tax answer.
That's really good intel, and it's so tough that we just have to be patient on it. But fingers crossed that it works out and that we can reclaim a lot of those assets. Transitioning over though, yeah, what were you gonna say?
Before we move on, Brett, though, one more thing to keep in mind with FTX. A lot of people had a lot of capital losses, unfortunately, in 2022. It wasn't just crypto, equities, a lot of tech stocks, really every asset class had, significant losses. Keep in mind that you can only deduct $3,000 of capital losses against ordinary income. So if you already had X amount of losses from equities, from other crypto, and you're looking at your FTX loss, if taking a bigger loss this year, if all that's going to do is increase your carryover into 2023, then it doesn't even make any sense to really sweat about it. At the end of the day, that's why knowing your tax position is very beneficial.
Right. That's that's definitely something that we need to look into as well. Really appreciate that insight. Uh, I do want to transition over to something maybe a little more positive. As we've seen recently, the market has made a huge rebound. Big shout out to the Glassnode research team actually calling the upward trend beginning on back on January 13th. Um, and then even to add on to the current run with the bank crisis going on, we've seen the market continue faster and faster upwards. Assuming the music keeps playing, what are some good tax strategies to minimize our after-tax net profits during these good times?
Yes, definitely. And I'm so happy to talk about profits in a bull market because it's always a little bit disheartening talking about tax loss harvesting losses and the bad, really losing money. At the end of the day, to get losses, you have to have lost something. I would rather get gains and have to pay taxes because that means I got something back. Anyway, honestly, the best piece of advice that I can give anyone is being cognizant of your tax position in each coin. Because this way, as you do any trades, as you decide to get it out of this asset into this asset, as you go, as you're making the trades, you can actually know what your potential tax impact would be. And honestly, for this, we have a very nice tool with Accointing. We have the tax loss harvesting tool, at which once you upload your data, we're going to show you every single tax position. That coin that you have on that exchange, is it sitting on a gain or a loss? That's an important piece of information. How much tax would you potentially have to pay on that? How much tax could you save on that? All this information, again, if you have this information with you, you can make a lot better decisions when trading.
Yeah, and I've heard that. So really, all you're saying is by understanding my positions for taxes, that's really my best strategy is just understand my positions. Could you explain a little more though, like using Accointing and how can your users turn this into a strategy?
Yeah, I mean, absolutely. So, try to break it down. So first things first, what I mean by this is that in general, knowledge is power, right? You cannot take action and optimize your tax position if you don't know what your tax position is. So right away, just by connecting all your wallets and exchanges to Accointing, we can help you actually see what this tax position is. Now, second, if you're a hodler, this is probably irrelevant, right? But for anybody trading, you need to actively consider your trades and the tax, as well as any other positions that you have as you're making your trades so that could there be a better trade to make? Could there be a better way to reduce your taxes? By the way, we'll show this all in an example and actually show you the tool in a little bit. But for example, consider you put $500 into two different coins at the same time. One of the coins doubles in value and now it's worth $1,000. And the other one, in typical crypto fashion, loses 90% of its value and now it's worth $50. So in the one, you have a gain of 500, 1,000 minus 500, 500. And in the other one, you lost 450. Suppose that you sell the winner because you're like, well, I doubled my money, I'm going to sell this. But what if you held on to the second coin, the one that went down in value? As you know, Brett, a lot of people in crypto, they see their coins come down, and sometimes they say, you know what, I think this coin is going to come back. So I'm going to hold it, even if it's down 90%. I know it's going to come back to all-time highs, and I'm going to be a crypto millionaire at some point in time. I mean, if you don't believe this, we can ask about coins like Neo, coins like IOTA, coins from the 2017 cycle that a lot of people are still waiting. EOS, for instance. Point being, a lot of people could have held a coin that lost 90% of its value and not sold it, and now you have to pay taxes on the $500 gain. But if you have this information, if you know that the coin is down that amount, before the end of the year, you sell that coin, you realize your $450 loss, and now the $500 gain becomes a $50 gain only. You realize your loss and you optimize your tax position. Now, one thing that I want to make clear here is that obviously in this example, it's very simple. And you guys may say, well, I can easily keep track of this. I can keep track of this in a spreadsheet or maybe with an abacus, whatever tool you want to use here. However, when you consider the volume of transactions in crypto, you oftentimes users have thousands of transactions. When you consider the fact that many trades are not fiat for crypto, they're crypto for crypto. There are different assets for crypto. Maybe it's a liquidity pool token that you traded for that crypto. Maybe it's an NFT. Maybe you got the crypto as staking, as a hard fork, different income events. How do you know what your tax basis is? And this is where we can really help you a lot and make it a lot easier. Because I don't know about you, but I would rather have software that can aggregate all this quickly and let me see my tax position so that I can focus on, okay, what moves do I want to make with Bitcoin and what is my tax position there? So I know, so I can plan better in general.
That's awesome. And thanks for sharing that. And that really speaks to me that there is a lot of things I need to plan and keep better track of as well. Beyond just following the market, you have to also think about the end of the year and how to really account for all of that. It sounds like, what about holding coins long term and like other types of strategies? Does it differ from strategy to strategy?
Yes. So as I said before, if you're a hodler, you're probably not going to use. There's not a lot of tax planning that you can do because why? If you're, let's say, like a Michael Saylor, you only want to buy Bitcoin, you're never going to sell it. Well, there is no taxes if you're never going to sell it. But even then, I would argue at some point you may have a life emergency, you may have to pay for a hospital bill, something that you may need to trade that crypto back into fiat. At that moment, you would need to know the tax basis of it. Why? Because the moment that you convert it back into fiat, whether you're buying a Tesla with it, whether you're paying a doctor, anything that you're doing, if you're spending the crypto for goods or services, that's a taxable transaction. So yes, even for hodlers, it makes a lot of sense. Now, if you're holding, here's the thing though, that if you're holding long-term, unless you're only holding one asset, chances are that you have more than one asset. And probably you're not betting 1,000, right? Most people pick some winners and some losers. So, think about somebody that's holding long-term, you're holding Bitcoin long-term, probably, Bitcoin, Ethereum, the good coins. Who says you didn't buy other positions a couple of years ago, that you're also intending on holding long-term, but coins that are just not performing well, coins that we're seeing the narrative move on. Again, thinking about coins like, EOS, IOTA, the coins from the 2017 cycle that we have not seen come back. And as you know, usually when you see a new cycle, you see new coins outperform other than the big ones. So point being, even a hodler could have tax positions that you could sell because again, at some point, you're probably going to have to liquidate that Bitcoin. Unless we move to the planet in which all payments are accepted in Bitcoin and everything changes a lot, you're going to need to go back into cash. So knowing what your position is in that and being able to offset any gains, and I'll give you a very good example with that just in a little bit when we demo the tool.
Cool. Thank you for sharing that. And that all kind of makes sense to me too. That if you're holding long term, obviously you don't have to, file for the stuff that you're currently holding, but you do have to, as you go in and out of those positions. So that makes sense. And I love being able to confirm this with a tax professional. Getting the free consultancy here. I think it'd be great though, as you just mentioned, to introduce the tax loss harvesting tool, which which you just mentioned. Could you walk us through, I guess, how you use it?
Sure, absolutely. If you don't mind me though, I'm gonna have to switch my screen very quickly. And I'm assuming you can now see the Accointing home screen, correct? Cool. So before I kind of deep dive into the tax loss harvesting, I just want to do a very high overview. This is our tool, this Accointing. This is our homepage, a portfolio where you can see your assets, performance, price, profits, everything. Your main screen that you're going to want to use, generally the wallet screen. And this is really where it all starts. Again, if you want to use a tax loss harvesting tool, we need to have the data. We need to have the information so we can provide your tax positions. In this case, I already have a hardware wallet and 3 exchanges connected. Nope, not my exchanges, unfortunately. These are test accounts, but to give you a little bit of a walkthrough, first, we're going to add a wallet. I didn't want to sit here and live have to connect everything. That's why its portfolio is pre-connected. But let me add here, I'm going to add my Matic wallet. And this just to give a demo again into how I need to copy my, there we go. And again, you can connect all your wallets via the blockchain, via the public address, not private keys or anything. Any exchanges via API, read-only. It's always only read-only data. And this is because we need to get all the transaction data so we can put everything together. By the way, this does mean we need the data from every single exchange and wallet that you're using. Yes, even the cold wallets. Again, if you transfer Bitcoin out of your Coinbase, out of your Binance, out of cracking whatever exchange you're using into your cold wallet, we need to be able to track that. Otherwise, it's going to be a tax nightmare, number one, on the transfer out. Number two, whenever you want to get the basis of that. Anyway, once you have all your wallets imported and connected here, as we can see, right now it's just finishing up importing my Polygon wallet, and now it's complete. Now, generally, you want to go through the review steps and review for any unknown currencies. In this case, we have a lot of the currencies that we're going to look at are specific liquidity pool contracts for different DeFi contracts that are not tracked in CoinMarketCap. But after you go through these steps, they generally come through fairly clean. It really depends on what you're doing. In these steps, I would definitely recommend looking at the biggest transactions first. What I mean by that, you're going to have a lot of small transactions that are for gas fees and such that, yes, in a perfect world, you want to get them, you want to lay them out, you want to review them, you want to make sure the data is correct. But what you want to make sure that you get right more than anything is if you transfer 2 Bitcoin somewhere, if you transfer 10 Ethereum, the bigger the transaction, the more attention you got to pay to it. So once you've gone through everything, you can go to the taxes tab, and here we have our taxless harvesting tool. And as you can see, this is going to give you a breakdown of every single asset that you currently have and the position, your tax position where the asset is. By the way, we're working on some nice UI improvements here, so keep an eye out on this tool. We're going to add a few new features that are going to let you use this, even make it a little prettier to look at. But anyway, let me give you an example. Suppose that I need to buy a new car, and because of the economy right now, because of interest rates, I don't want to take out a loan. I know that I have some Bitcoin and I just want to pay for it with Bitcoin. Unfortunately, Elon stopped accepting Bitcoin for his Teslas, so I got to cash out. So the question is, I have a few Bitcoin here. Which one is the right one that I should take out? Let me zoom in a little bit. So point being, this tool is going to give you that position, your tax position into every single position. As you can see here, we have an exchange 1, exchange 2 on a hardware wallet. We have 4 different positions of Bitcoin. These got in up a little bit, so 0.9995, but anyway, just about 1 Bitcoin in each. And obviously these were each acquired at a different point in time. So not only are we going to tell you when the positions become long-term, if it's long-term or short. In this case, this one is already long-term. They're all long-term, but you can also see the unrealized gain and the tax impact. So taking a step back, I want to liquidate 1 Bitcoin, let's just say about 1 Bitcoin. So don't mind that it's 0.9995. So I look at this data, and from this data, I can tell that if I sell this one, it has the best tax outcome. Why? It has the lowest unrealized gain and the lowest tax impact. This is the amount of cash that we recommend setting aside to pay for the tax. It is based on the highest marginal rate right now. So if anything, we're overstating it to give you a little bit of extra cushion so that when you come to year end and you pay your taxes, you have that cash set aside. But point being, you cash in that Bitcoin, you get your $28,000, and now you know that you have an $18,000 gain, and you know exactly how much you should be setting aside, which is about $4,396. So you want to make sure to set that aside from the 28K that you took out. Now, here's a cool thing though, that later on, not only is this going to help you with tax planning, and by the way, whatever you do not turn that coin into something that's subject to fluctuations. Usually people would say stable coins are okay, but we've seen UST. We've seen the DPEG of USDC. Imagine that you turn these $4,000 that you're going to set aside to pay for taxes. Imagine that you invest it into Ethereum or whatever other coin, and we go down 50, 60, 70%. You don't want to do that. You don't want to take risk with your tax money. Now, at the end of the tax year though, suppose that you already sold this Bitcoin. You already bought your car, and this was back in May, April, whatever. Now you're looking at your tax report, and it's December 30th, and you're saying, boy, I have $18,500 of gains. Again, we're assuming that you already sold that Bitcoin. And you're trying to decide, how can I bring this number down? You set aside this cash, but you're saying, you know what, if I don't have to pay this tax, I don't want to pay it. So you scroll down and you look through other positions and you identify that, ooh, look at Chainlink. That's sitting with a $41,000 unrealized loss. Now we've color coded here the numbers to show the losses as red, gains as green, and show you the positive tax impact as green, negative tax impact as red. So in this case, again, if you only had the 18,500 gains from Bitcoin here, you would only have to sell about, let's say about 50, 45% of this position to get, to get this amount of unrealized loss. Maybe you have other gains, maybe you sold some Tesla stock early on or whatever stock you may have sold, and maybe you do need to sell everything. Point being, you can come back later in the year, sell the appropriate amount, and then your tax report, you're still gonna have this gain, but now you can use a loss against the gain. And now instead of having to pay taxes on an $18,500 gain, you either pay taxes on a $0 capital gain, if that's what the bottom of your Schedule D says, or you might even get $3,000 of excess capital losses that you can apply against any ordinary income. And honestly, this is the best way that I can tell you. This is the beauty of this tool. It's simple, but at the same time, I can't tell you how many people don't do this. Just being cognizant that when you sell something, there's going to be a tax. You want to set that aside, knowing your tax positions. Even if you make trades and you don't save the tax money, then just be cognizant of what your tax position is. Why? Because capital losses can offset capital gains. So if you know your tax position, you can just come back and sell anything that you've lost to bring that down. What do you think, Brett?
Gotcha. No, that was really informative actually, and a lot of things that just I think doesn't cross the average investor's thought process, but like it really does make a lot of sense. I guess just switching topics a little bit. Sorry, I'm trying to collect my thoughts here. Can we talk a little bit about just some of the common mistakes we see when people are filing their crypto taxes?
Sure, absolutely. Let's skip over. Yeah, I mean, I can tell you the top mistakes that we see when people filing crypto taxes. It first and foremost, and the one that could ruin your life the most would be not paying your crypto taxes at all. And that's number 3. Obviously, back since the IRS released Notice 2014-21, along with the FAQs that you can find if you just Google cryptocurrency FAQs IRS, you can see all their FAQs that have been up there since 2014. They regularly update them. And I think at this point, everybody and their grandmother knows that crypto is taxable. If you exchange one crypto for another, it's taxable. If you exchange it into fiat, it's taxable. These assets are taxable. It is taxable as property. You have to pay your taxes. This is at this point, everybody knows that. So, not reporting your crypto taxes in 2023 for 2022 tax year, if you make gains, it is very difficult for any taxpayer to say, I'm sorry, I didn't know that I had to report this. Because at the end of the day, I think, we see this everywhere in the headlines, especially if you're into crypto. So I put that as number 3 though, because even though it's the one that could hurt you the most because of the potential criminal impact or criminal liability with that, I would say number 1 is probably the biggest mistake. Why? Because as you can tell, sometimes crypto taxes that can be complex. There's challenges with the data. That's the biggest challenge I can tell you. Every exchange, every blockchain, every dApp, the data is not standardized. So oftentimes, a lot of the different platforms, it's difficult putting all this together, especially if you don't do your due diligence. It is so easy to forget connecting a wallet, one of your hardware wallets, and then suddenly when you withdraw that Bitcoin from whatever exchange you were on, that's going to look like it was a taxable withdrawal. Suppose that you transferred, 2 Bitcoin out of an exchange into your hardware wallet. Suppose that your tax basis for each one of those was about $5,000, you bought early. So as of today, you would have 2 Bitcoin is about 56,000. The basis would be about 10,000. So you got about a $46,000 unrealized gain. Suppose you transfer that to your hardware wallet and you don't connect your hardware wallet. Well, that's going to look like you transferred it to somebody else as if you were paying for services, for a product, for something. That's a taxable gain. That's, as I said, that's a $46,000 of a taxable gain that should not have been a taxable gain. Why? Because you did not correctly connect your hardware wallet and you did not correctly link the internal transfer. Look, if you transfer Bitcoin to yourself, that's not a taxable transaction, but you have to know how to identify the data and make sure that it is correct. We automate most of that unless it's unless you have a couple of transfers that are somewhat similar within the same time range, in which case we'll put it on the user to say, hey, identify which is a proper. We automate most of these transfers. So all you have to do is make sure you connect the right wallets and just verify that, again, you don't want to be paying more tax than what you have to. The second one I'd say is just not planning for a tax bill. We already went over that example, with smaller dollar amounts, or I guess, smaller, it's all dependent on the perspective of the person. But again, $28,000 of Bitcoin that the person sold, you could have had an $18,000 gain, which would have been about a $4,000 or $5,000 bill. Now, suppose you're in California, New York, some of the states that have a much higher state income tax, up to 10% or over that sometimes. That can be a pretty hefty tax on that. But if you just plan for taxes and you know the information, we already saw how you can sell that at the end of the year and minimize your bill, literally get it down to zero for capital gains taxes. So again, not planning and not keeping track of your information is one of the biggest mistakes. We already touched on not filing for crypto gains, but then not reporting any 1099s received. We have not seen 1099s in the crypto industry for too long. A couple of years ago, we were seeing a lot of 1099Ks. The 1099K, that's not the correct form that any exchange should be issuing for gains or losses. That form was actually created for something totally different, to report merchant revenue through credit cards. But the problem is that absent guidance, some exchanges decided, okay, we're going to start using this form. Generally, what I tell people, if you get a K, which you probably are not seeing too many of those floating around today, but if you get one, you don't have to match the information. However, that does tell you that the IRS has a copy of that. Why? Because every single time that somebody sends you a 1099, the sender of the 1099 has to file a copy with the IRS and with the state tax authorities also. So point being, if you get a 1099K, that's not a gain or loss 1099. It doesn't have useful information to report, but it does give you the indication that they reported to the IRS and that they have your social security number. So, hey, better make sure to report that exchange correctly. But with that, now we're seeing different 1099s. 1099 MISC. This 1099 is used to report miscellaneous income. We're seeing this used by exchanges for staking, for rewards. You get this 1099 if you get more than $600 of income through the exchange. This is income, not gains. So again, staking, rewards, anything like that, if you get more than 600, you got to report this, and you got to report it as miscellaneous income. Now, last but not least, we're starting to see some 1099Bs also. In a couple of years, we're going to start to see the 1099DA, the A for digital asset, but we're still waiting for regulations right now. Until then, some of the exchanges are using the 1099Bs, which are the 1099s used to report gains or losses from securities. Now, the challenge with this is that not every single exchange has to issue. It's on an exchange by exchange basis. Some of them are choosing to issue them. And same with the 1099 MISC, you have to make sure to not double report this income. Why? Let me give you an example. Suppose that you're trading on Bittrex. Bittrex, which unfortunately we just saw that they're withdrawing from the US recently. But suppose you trade it on there and they issue a 1099B. And a 1099 MISC also. Let's just say you got some staking on Bittrex. Now, Bittrex is only one of the 10 exchanges and DeFi wallets that you're using within your Accointing portfolio. You should have Bittrex connected. Why? Because if you transfer crypto back and forth, it has an impact on your tax basis. But now what do you do when you get a 1099 from Bittrex, the 1099 for staking, you get a 1099 for your trades. And now the same income, the same trades are also reported on your Accointing report. So you got to be cognizant to make sure that you're not double reporting that. That's why we provide an Excel report that's easy to filter out. You can easily filter out certain exchanges and then, just get the right pieces of information. But that's very big because at the end of the day, you definitely want to pay the tax. You want to pay your fair share, but you don't want to overpay, and you definitely don't want to pay the tax on the income twice. So I think, Brett, that's probably my top 5 that I've seen. This from talking to a lot of users, clients of mine in the past, but I don't know if there's any others that are, that you're thinking about, but those are the top things that I warn you against.
No, and those are definitely a few that would have come to mind, and a few that really wouldn't have. So definitely really good intel for us, and thanks for sharing that. We're starting to get closer to the Q&A portion, but just a few last things. I wanted to know, just in your opinion, how could I get an accurate tax report just with the least amount of effort?
Yes, definitely. So obviously, it's kind of a loaded question. So at Accointing, we've chosen to focus on, make crypto taxes as easy as possible. A lot of our focus has been on making the UX, the UI as easy as we can, make it as user-friendly as we can, because why? Crypto taxes are difficult, getting the right data, classifying transactions, figuring out how this reported by the IRS, or trying to figure out how they would like it reported when they haven't issued any guidance. This is all very difficult. So connecting everything should not be. That's to try to make the import flow as easy as possible. We have as many integrations as as our engineers are able to integrate every single day. But the best way that I can tell you is by being proactive in your tax planning and managing everything. So let's go back to what the demo that I just gave you of the tax loss harvesting tool. Once you have everything connected, you're going to be able to track your positions, know how much tax you have to pay, and on the Bitcoin that's appreciating, that's going up. You'll know what moves to make on the downside. By the way, the only way for that tool to work is if you connect all your data. You know what the beauty of that is that not only can you plan for taxes, not only can you make the right moves, can you sell the right coins, do the right things, but then when it comes time for tax season, all you got to do is click generate tax report and you're done. Maybe you have to add another exchange because maybe you just started using a different DeFi platform or something, but point being, your work is going to be a lot less than if you wait until, maybe today to start connecting your wallets and everything. Now we are trying to, we're trying to add as much AI and different things so we can to try to make things a lot easier to auto classify transactions. But obviously it takes a little bit of time because there's just so many different blockchains, so many different exchanges that, keeping track of the data, it's challenging. So that's again why, if you look at the way we've been going about it, every one of the bigger exchanges, blockchains, we definitely support them. If there's anything that anybody on here, if you're using a certain blockchain that we don't support for any reason, definitely reach out, let us know. But again, the main trick to getting a tax report as easily as possible is just being diligent with your data. Now, if you're really in a rush, if you really need it by next week and you have 100 different wallets and you don't know what to do, first, I would recommend extending your tax return more than anything. By the way, it's also a recommendation that I would give for anybody that has, if we go back to the FTX case, if you're unsure about it, extend your tax return. There's no guarantee that we're going to get more guidance, but this was a very big case. This was, the impact of this. John Ray said it. This was bigger than Enron, at least as far as the lack of internal controls and the failure. Point being, every regulator knows about it. Everybody has it top of mind. So there is a possibility we see some guidance if you extend. Back to the question that you had asked me though. If you really have a lot of wallets and exchanges, I would probably recommend extending at this point. Depends on how deep into the DeFi world and some of these more degen products you are. The more that you're using some of these, the more work that it's going to take. But at the end of the day, again, the best approach that I would take is just upload your data and even run a tax report. This is the way that I do it. I generally upload my data, run a tax report. And by the way, in the tax report, we summarize your gains by coin. Okay. Most people have a fairly good idea of what you had in a coin. So what I mean is most people know, well, I bought Ethereum for about $500 a couple of years ago and I sold it at this point. Or, no, I specifically did not sell my Bitcoin. Sometimes just by running a report and identifying the issues, you can see what you forgot to do. For instance, if you run a report and you see that your your gains are overstated, you might find out, oh, this gain is triggered by me transferring the crypto out of this exchange into my hardware wallet. Oh, that's right, I forgot to connect my hardware wallet. So honestly, Brad, unfortunately, right now there's no silver bullet that's going to generate a tax report in 1 minute. But again, connecting all your wallets and just take a approach by magnitude of the trade. Look at your big pieces first. And then if you need more time because you have a lot of big pieces, definitely take advantage of being able to extend your tax return. A lot of advantages in the US that we're able to do that. Many other countries don't get that luxury. So I would definitely recommend it.
Cool. I really appreciate hearing that. Just to switch pages here. We're going to step into Q&A for a second. But for those who don't know, you can't file taxes unless you had something to invest in. And if anyone is ever looking into really learning how to properly invest and getting the tools to do so, the Glassnode team is happy to help as well. We are partnered with Accointing, and we help keep track on whale movements, derivatives, exchange balances, and really just about every aspect of the market you could think that you could need for your investing purposes. We offer insights on our own platform as well as API integrations, and there's thousands of investors already using us. As I mentioned earlier, my taxes are looking a lot different already this year, just seeing as our analysts advised to re-enter in the market as of January 13th. So I'm thrilled with what's been going on as of lately. One other piece to note before we get into Q&A is that next week, the Glassnode team is going to be running a webinar on Friday to review how you could be alerted of events such as the USDC pegging days or hours before the event actually occurs. It'll all be looking at on-chain signals, such as volumes, big trades, and that type of event, and showing you just past stories of how we've been able to help investors identify and be alerted of events before they occur. So with that, that concludes the main portion of our webinar, and we'll move into the Q&A section. We already have several questions already within the document, but feel free to continue asking more. I will go from top to bottom and just go over some of the more relevant questions we found. And
Brad, while we do that, I did
Mhm.
put up a slide that anybody buying a US tax report, you'll get 30% off your package right now.
That's right. You just have to go to the Accointing webpage and just sign up via the webpage, correct?
Yes, and you can connect your wallets. You can even use a tax loss harvesting tool today, absolutely for free. I can't promise that's going to remain like that forever, but you can do everything for free up until the moment that you got to generate a tax report. And at that point, if you can get 30% off. By the way, you don't have to enter a coupon code. This is for every US customer heading into the deadline.
Awesome. So definitely make sure to go capitalize on that and get your 30% off. But David, let's get into questions. I have 11 written down on my sheet right now, and let's just walk through them. So the first question was, is an ETH to wrapped ETH transaction taxable? If you're marking it as not taxable, is that a big risk?
Boy, that's a really good question to start out with. Let's start with questions that we don't have an answer to. Thanks, Brad. In all seriousness, so as I already alluded with that joke, but not so much of a joke, we don't have a strict answer to that. If you look at the tax law, if you look at the guidance, it says, cryptocurrencies or digital assets are property. So each time that you trade a different asset, that's considered a different, you're trading a different asset. Like, you will find people, if you talk to different accountants, you'll find CPAs who'll say, you know what, it's the same asset. It's basically the same pricing. Just because it's called something else, it doesn't mean that it is something else. You'll find people saying, nope, it's a different asset. I can't tell you where I sit on that. If you want to know where I sit there, we'll have to work one-on-one as you guys being my client. But point being, it's all a risk, measuring the risk that you're taking by reporting that it's non-taxable. We don't have full guidance, right now. If you want to be extra careful, I would report it as taxable. If you want to be a little bit more aggressive, you can report it as non-taxable. But just know that there is a risk that the IRS could come back and say, actually, this was taxable. The extent of the risk, that's difficult to tell. It definitely depends on the amount of money. Are we talking about, I don't know, you converted 0.5 ETH to 0.5 wrapped ETH? Probably not as big a deal in the IRS's, view, as opposed to, are we talking about 500 ETH into 500 wrapped ETH? The thing about tax law is that, yes, you have to report everything accurately to the dollar per the law. It is the law. But at the end of the day, the IRS and other tax authorities are going to work on a risk approach basis. So they're not going to look at every single transaction from every taxpayer. So depending on the size, depending on the dollar amount, again, what part of your portfolio is that, but you'll have to find the best information and just as I said, just going to take a position. But generally, I would probably say taxable if you want to be the safest.
That makes sense and really makes you think that you got to be very sure with the trades you're doing. Next question is, and quite a few words here, so bear with me here, but I have 2022 crypto rewards from Celsius categorized within Accointing correctly as tax income. However, due to Celsius's bankruptcy, they've advised me that some of these rewards between selected dates should not be considered taxable rewards. Question: how should a correctly categorize these non-taxable rewards in the Accointing application so they are not evaluated as taxable?
So that is really interesting. And by the way, thank you for that. I never used Celsius. I did use BlockFi, but never Celsius. So I haven't seen this personally. Now, if they specifically send you communication, I would make sure that it is from the exchange. I can definitely research that for you we can follow up after. But if they specifically send you communication saying these rewards are not taxable, because obviously they have other things that they have to take care of in the back end. If they sent you this, you can simply go into the transactions Accointing where you see the income coming in from the rewards, and you can edit the value as 0. That's going to make the reward show as, it'll still show up as income, but it'll give you a $0 income and no basis in that. So that'll be the best way to do it.
Good to know. Next question. Can you summarize gains and losses for NFTs and crypto on tax forms, or do you need to show individual line items for every currency/NFT?
No, you can definitely summarize your gains and losses. So if you look at the instructions to the form 8949, they specifically say you have to report every single transaction. Obviously, this is very difficult, especially in crypto when some people have 20,000 trades a year. It is impossible. Now, if you look at the instructions of form 8949, it also tells you are able to, if it is impractical to give all the detailed information, you're able to summarize the data, put a summarized entry, for instance, various cryptos, proceeds, cost basis, gain or loss. At a minimum, you always have to break it down into long and short term. Why? Because those have different tax rates. Short term is going to be at ordinary rates, long term at preferential rates. But at a minimum, you have to break it out. And actually, if you look at our tax report, which I can quickly flip to right here, this is exactly why we break it down for you this way. You can see your short-term gains, your long-term gains. So if you wanted to, at a minimum, you could report your taxable disposals, your short-term ones, in 8949 box C, 8949 part 1C, taxable disposals long-term, 8949 part 2 box F. Keep in mind that if you do get a 1099B for any trades, anything that you have in there, you need to look at the instructions of the 1099, and that may fall into a different section. But again, to answer your question, if you don't get any 1099s and all you got to report is your DeFi trades and other transactions like that, you can literally just take these numbers. You do need to send an attachment though with information. So that's one thing. They tell you can summarize, but you need to provide an attachment with the same information. And if you're using Accointing, you can take the 8949 CSV files. Those have the right amount of, those have just the perfect right amount of data. And you can either print it to PDF or format it in whatever format that you need to, and that can serve as your attachment.
Makes sense. Awesome. Thanks for answering that. All right, next one is, can you discuss what expenses can be legitimately claimed against mining revenue, and what limits should we be aware of?
Yes, so that's a very good question. I would ask, are you mining as a trader business, or are you mining as a hobby? And that's a key question there. If you can claim any business expense, electricity, advertising, payroll, if you're paying someone, utilities, anything, if you're in a trader business. Now, unfortunately, the Internal Revenue Code tax law doesn't really specify what qualifies as trader business. If you look at case law, they focus they focus more on case by case basis and more overall guidance as opposed to a clear cut. If you're doing this, you are in a trader business. If you're doing this, you're not. Point being, for Bitcoin mining, just think about it logically. If if you're not doing anything active and you're simply clicking a button once a week that says collect rewards, and there's very little that you do, you're probably not in a trade or business. If you're not in trade or business, you would report this as miscellaneous income, and there's no expenses you can claim against this. You report as miscellaneous income when you get the Bitcoin rewards, then that becomes your tax basis, that Bitcoin, and then you can, when you sell that Bitcoin, you would be able to deduct the tax basis. Well, you wouldn't get any other deductions unless you're in trade or business. If you're in a trade or business, however, now you can deduct electricity. You can capitalize the cost of the mining hardware, the GPUs, whatever you're doing, you can capitalize it, you can expense it. So if you're in a trade or business, by the way, go check out our tax guide. I explain this in, as well as I can. If you are in a business, then you can deduct any necessary and ordinary business expense.
Awesome. Good to know as well. Next question, is there an option in Accointing to combine positions across wallets? If using FIFO, I would expect selling one Bitcoin from wallet one or wallet number two to have the same tax impact because they're both owned by me.
So there is an option. I would definitely warn you against this though. That's if you go to your tax settings, that's a setting that shows multi-depot or single depot. Basically the difference in that is, do you treat every single wallet as its own virtual tax lot, or do you treat everything as one tax lot? The reason that I would advise against doing the latter is because as we're getting ready to get 1099 regulations, the 1099s are going to be reported on an exchange by exchange basis. So your question is, let's say a couple of exchanges, I buy one Bitcoin on Coinbase and one Bitcoin on Gemini. That one on Coinbase I bought for, I don't know, $5,000. The one on Gemini for $60,000. Now I sell the one on Coinbase because of whatever reason. This one obviously has a $23,000 gain today. The one on Gemini has a much bigger loss. Well, it has a point being, if you sell the one on Coinbase, can you say that it was this one? That's probably not going to work. And if you look at the IRS FAQs, they specifically say specific ID is the preferred method, meaning if you sell this one, it has to be this one. But again, it's, you can do it today, but I would definitely recommend against it based on it has a high risk of getting challenged, especially if it is a high dollar amount, and being cognizant of the direction we're headed with 1099 reporting.
Makes sense. We want to make it as clear as possible for the tax authority. Another question, we got time for just a few more, would be, can you comment on carrying over losses and gains too from one tax year to another? Can these be rolled over more than 1 year?
Well, the good thing is that you don't have to carry over gains ever, because gains just going to stop at gains. If you have gains, ultimately that's going to get reported and you'll have to pay tax on that income this year. Now, if for whatever reason you have gains that you cannot afford to pay the tax because maybe you traded some crypto and you traded it back into another crypto or something, you can always make payment plans with the IRS. But that's to the extent of it with gains. With losses though, here's the thing. Yes, you can deduct every single loss in crypto and other assets and any property, anything that goes through the Schedule D. Now, if your losses exceed your gains, yes, you can deduct more losses than gains. So the way this works is you take your short-term gains and short-term losses, you net them against each other first. Then you take your long-term gains and long-term losses, net them against each other. And then you have a net short-term gain or loss and a net long-term gain or loss, and you combine that against everything. Why do I say this? Because at the end of the day, long-term losses can also offset short-term gains and vice versa. It may impact the character of your gains because depending on the breakout of short and long, you may have a different combination there. But anyway, if you do go over your losses, if you brought down your gains all the way to zero, and now you have a net loss for the year, you can deduct $3,000 of that against all other ordinary income. This is against your wages, against interest, dividends, against business income, any active income. And anything over $3,000, you can carry it over and it maintains its character. So, in the case that I have, I don't know, $50,000 of losses, I can use 3,000 this year and I can carry over the remaining 47,000 into next. And if I don't use them next year, I can carry them over. So essentially what this does is it gives you, if you have $47,000 of carryover losses, you kind of know that your first $47,000 of gains are tax-free in a way.
Makes sense. All right, two more questions, I believe, is all we have time left for. One here is the FTX US site is shut down, which means that they can't get their transactions to do your return. What does the IRS consider if the information to do your return is not available?
So I had seen early on that FTX was supposedly going to make the data to report your taxes available. I mean, in this case, it's kind of a case by case basis. So if you traded an FTX and you realize your gains or losses, should you report it? In theory, yes. But what happens when part of your data is available, but then you forgot to update your data and it's like, huh, how do we get that data now? So I had seen before in doing research about FTX that they were going to make the data available. I haven't seen this personally. I'm definitely going to double check after this. But I have also seen that they're likely going to be issuing 1099Bs. The 1099Bs are the forms that give you the actual gain. So I would wait for the 1099B, but for all these reasons, I would definitely extend your tax return. Again, it doesn't hurt, and there's so many unknowns right now that it's just going to give you the benefit of the, having extra time. If you extend it by the 18th, you'll be able to file it this year all the way through October 16th.
Awesome. And then we've received this question a few times. Could you talk about the benefits of Accointing versus Zen Ledger and some of the other companies out in the market?
I mean, I think the first and best benefit is that we have Glassnode, because with the reason that we decided to, the reason we worked with Glassnode and why we're the same company today is that it just makes sense for the users. Start out by making the right decisions. Do I buy Bitcoin today? Do I sell? Which way is the market headed? How many active addresses are there? Are most people sitting in profits, losses? All this data, that's data to make the right decisions. That's where it starts. It doesn't start with taxes. And after that, after you make your trades, now you're going to report taxes. But the coolest thing is that we are further integrating the products. Obviously, we've only been the same company for less than a year. We're going to see much cooler integrations coming up, such as even being able to get more data intelligence behind your own portfolio. Imagine seeing every time that you buy and sell a little bit of more intelligence for that. Beyond that, if we're focusing only on the Accointing product, I would say, at the end of the day, while I want to say that we're the best, realistically, every competitor has some things that they do well and some things that they don't. I would say for Accointing, we're definitely very strong on the DeFi side. We have an amazing UI, a very nice interface and a very nice importer that, if you compare us to a couple different competitors, you'll see you'll import all your data a lot quicker with us. And I would say at the end of the day, it's the, the ease of use and our focus on DeFi and a lot of these products that, it's a little bit harder to handle because you come to find out every dApp is different, every protocol is different. So I would say those are the best. I don't know, Brett, what you think. It's like Glassnode looking at Accointing, but that's what I think about us, at least.
Yeah, and just speaking from the Glassnode side is the roadmap of joining our two companies together is really going to give you the full cycle, seamless experience. And I think that's really the long-term solution that we're all looking for. So anyways, thank you so much for your time, your insight and everything. Just a closing remarks here before we sign off for the day is remember everyone to file by the 18th of April or make sure to extend by the 18th. Remember the insights we reviewed today regarding tax loss harvest, importing your DeFi data, maintaining quality records of your accounting statements and making sure that you're properly filing. That way there's no hiccups or confusion moving forward. Last few things would be make sure to obtain that 30% discount just by going to the Accointing website. And yeah, make sure to get that in, before that tax deadline comes up. That's all for me, but I'll pass it over to you, David, just for a few final statements.
Yeah, I think more than anything, crypto, as I said when we started the webinar, we're at a very pivotal moment right now in the US where we see every day the SEC issuing a Wells notice to Coinbase. You saw the CFTC lawsuit to ZZ, and there's a lot of uncertainty. More than anything, there's a lot of thought today in crypto, but it feels like real uncertainty and doubt right now. Don't give them one more tool. Report your taxes. Do the best that you can. Don't give them even more ammunition to say, well, you guys are not even paying taxes. You guys are not even reporting. At the end of the day, any issues about the SEC suing Kraken for their, providing staking or things like that. Those are on a SEC to these protocols for exchanges relationship. On the consumer side, though, report your taxes. We've known about this. Don't take unnecessary risks. Make sure to keep a clean record and just be able to sleep soundly at night. That way, that's one less thing that you have to worry about. We already have to worry about too many things with crypto in the US right now.
You're totally right. And hopefully there's less to worry about in the road to come, but this market is one of those markets that you always got to be prepared. Thank you so much for the insights, and it really was informative. And thank you everyone for joining. And I hope we were able to provide some valuable insight. Thank you so much.
Take care.